You twist the key, and the engine growls awake, blasting a rush of warm air through the vents to push back the cold bite of the morning. Yet as your hands settle around the steering wheel, the knot in your gut has nothing to do with anticipation or adventure. What you're feeling is unmistakable fear. Outside the windshield, a steady, colorless drizzle blankets the Pacific Northwest, smearing the road ahead and echoing the dark clouds forming over the housing market in this part of the country. For years, you looked on as Washington and Oregon were celebrated in glowing headlines as bulletproof places to build wealth, fueled by red-hot tech growth and a constant influx of cash-heavy buyers relocating from California. But as your tires merge onto the slick lanes of Interstate 5 and you head deeper into the gray, the truth unfolding around you tells a far more unsettling tale. For sale signs linger on perfectly trimmed lawns far longer than anyone remembers, slowly fading, collecting moss, and becoming fixtures rather than advertisements. The moving trucks lining the shoulders aren't delivering hopeful newcomers chasing opportunity. They're loaded with belongings, carrying families away as they abandon the region altogether. We're about to take a sobering drive through 10 cities where the promise of the American dream is unraveling into a financial disaster. Along the way, you'll see everything from a once-thriving high-desert hotspot, watching its housing bubble collapse in real time, to a major urban center where rising crime and failed policies are dragging property values straight down. You need a clear view of where experienced investors are pulling out while they still can. If you already own property in these places, or you're tempted to buy the dip, you may want to pause and rethink before grabbing a falling blade. And before we arrive at the city sitting at the top of the list, now overwhelmed by an unprecedented flood of unsold homes, there's plenty of ground to cover. Be sure to subscribe and hit like so we can keep steering you clear of costly mistakes. Now buckle up, switch on the wipers, shift into drive, and brace yourself. We're heading straight into the wreck. Number 10. Salem, Oregon. You head south into the core of the Willamette Valley, the steady hum of tires on asphalt accompanying you as you roll into Oregon's capital. For decades, Salem carried a reputation as a calm, dependable government town, quiet, predictable, and largely shielded from the dramatic ups and downs that rattled other housing markets. But as you pass the towering presence of the state capital, it becomes obvious that this sense of security is starting to crumble. The protective layer that once insulated Salem's economy has worn thin, leaving the city fully exposed to the unforgiving reality of a market in correction mode. Not long ago, Salem was seen as the budget-friendly escape for buyers who had been priced out of Portland. That price advantage, however, vanished with shocking speed. Home values surged so aggressively that local incomes simply can't keep pace anymore. Glancing out the window, you notice block after block of mid-century ranch houses, homes that would have ignited fierce bidding wars just 2 years back, now sitting quietly on the market. Their asking prices have been cut again and again, subtle but telling signs of sellers growing desperate. The numbers behind this slowdown are hard to dispute. Recent, in-depth data from Redfin shows that more than 34% of listings in Salem have undergone price reductions, meaning roughly 1 out of every 3 sellers is being forced to concede that their expectations were unrealistic. Inventory tells an equally troubling story, with active listings jumping nearly 22% compared to last year. Homes are lingering longer, too, as days on market have climbed over 15%, reflecting buyers who are unwilling to commit under today's high mortgage rates. Even more alarming is what's happening with investors. CoreLogic data reveals that investor purchases in the area have dropped by more than 45%, a strong indication that seasoned players no longer see viable returns here. The median sale price, which exploded during the pandemic housing frenzy, has slammed into a hard ceiling and is now down close to 3% year over year when adjusted. And perhaps the most unsettling sign of all comes from foreclosure filings, which have risen 12% compared to the previous quarter. As you leave Salem behind, the takeaway is unmistakable. Even a city anchored by government jobs isn't immune to economic gravity. Number 9. Olympia, Washington. You leave Oregon behind, crossing the Columbia River and pointing the car north as the interstate carries you toward another state capital, this time in Washington. Olympia welcomes you with dense greenery and postcard-worthy views along the water, the kind of scenery that makes everything feel calm and prosperous. But you know not to be distracted by the surface. As you wind through the streets near the Washington State Capitol campus, There's an unmistakable strain hanging over the local housing market. During the pandemic, Olympia became a magnet for remote workers eager to escape Seattle's high costs and overcrowded lifestyle. That sudden influx of buyers pushed home prices to levels the local economy was never built to sustain. Now, with corporations enforcing return-to-office policies and the tech industry cutting thousands of jobs, the manufactured demand that once buoyed Olympia is disappearing fast. The remote work premium has vanished, leaving many sellers stuck with homes worth less than what they paid. The data coming out of Olympia paints a harsh picture for anyone still optimistic about this market. According to detailed Zillow figures, roughly 55% of homes are now selling for less than their original asking price. In other words, most sellers are walking away disappointed, taking a financial hit they didn't anticipate when they listed. At the same time, activity has slowed dramatically, with pending sales plunging 18% compared to this point last year. Supply conditions are shifting just as quickly. Months of inventory, a critical measure of market balance, has swelled to more than 3 months, a clear signal that bargaining power has swung decisively toward buyers. Local real estate groups report that new listings are up 12%, pouring even more homes into a market where buyer interest has stalled. Unsurprisingly, the average sale-to-list price ratio has slipped to 98%, wiping out the premiums and bidding wars that once defined the area. Beneath the surface, more warning signs are flashing. Mortgage delinquencies in Thurston County have crept up by 9%, often an early indicator of future distress sales. On top of that, the median time it takes for a home to go under contract has nearly doubled, stretching from about 2 weeks to almost an entire month. As you ease back onto the highway, one thing is clear. Olympia is dealing with a brutal hangover now that the remote work boom has come to an end. Number 8. Bend, Oregon. You cut east, leaving the familiar valley behind as the road climbs over the Cascade Mountains and drops you into the high desert of Central Oregon. Bend is undeniably stunning, a dream destination for outdoor enthusiasts with its mountains, rivers, and endless recreation. But once you arrive, it's clear you're staring at one of the most textbook examples of a Zoomtown collapse anywhere in the region. At the height of the pandemic frenzy, Bend was arguably the hottest housing market in the Pacific Northwest, swarmed by equity-rich buyers from California and Seattle who snapped up homes sight unseen. Now, as you cruise past sleek luxury condos and sprawling new developments on the west side of town, the quiet is almost unsettling. The trails and breweries are still packed with visitors, but open houses sit eerily vacant. Bend's housing boom was built almost entirely on two fragile assumptions: permanent remote work and dirt-cheap borrowing costs. Both of those supports have crumbled over the past year, and the fallout is impossible to miss. The numbers here are among the most extreme on this entire journey. Data from Realtor.com shows that Bend's median listing price has already corrected sharply, dropping about 6% from its peak. Inventory has surged dramatically as well, now sitting roughly 40% higher than it was just a year ago. This tidal wave of listings has overwhelmed the market, handing buyers more choices than they've had in years. Homes are no longer flying off the shelf either. The absorption rate has collapsed, and properties now linger for a median of 55 days, an eternity compared to the breakneck pace of just 2 years ago. Even more alarming, vacancy rates for investment properties and second homes have climbed to nearly 8%. As short-term rental income dries up, many owners are being forced to sell simply to stop the bleeding. Builders are feeling the pressure too. Permits for new single-family homes have fallen by 25%, signaling panic among developers who see demand falling off a cliff. Price per square foot has slid another 4%, wiping out recent gains for buyers who arrived late to the party. To top it all off, aggressive price cuts now appear on 42% of all active listings across Bend. The verdict is clear as you roll out of town. The high desert boom has ended, and what's left behind is a market slowly settling into the reality of a very painful bust. Number 7. Tacoma, Washington. You drop out of the mountains and re-enter the familiar gray, rain-soaked stretch south of Seattle as Tacoma comes into view. Locals have long called it the City of Destiny, a place known for its rougher edges and blue-collar identity, traditionally offering a more affordable alternative to its glossier neighbor to the north. But as you pass through neighborhoods near the port and into downtown, It's clear that the overflow from Seattle's housing frenzy has done real damage here. When buyers were pushed out of Seattle, they flooded into Tacoma, driving prices far beyond anything that made sense for a working-class city. Now that Seattle itself is cooling, Tacoma is taking a hit from both sides at once. Daily commuters are worn down by relentless traffic, while investors are losing patience as profit margins shrink. The city's economic foundation, built on middle-income households, is straining under the pressure of high mortgage rates and bloated home values. The data confirms just how quickly the ground is giving way. Figures from the Northwest Multiple Listing Service show that active inventory in Tacoma has surged nearly 95% compared to last year, an enormous wave of supply that the market simply can't digest. At the same time, closed sales have fallen 22%, a clear sign that buyers are stepping back and refusing to engage at current prices. Home values are already sliding. The median sale price has dropped by about 5%, a painful blow for anyone who bought near the peak. Distress is becoming more visible as well, with foreclosure starts in Pierce County rising 14%, pointing to growing financial stress among borrowers. To make matters worse, the average mortgage payment now eats up more than 45% of the area's median income, effectively locking the typical resident out of homeownership. Even deals that make it to contract aren't safe. Cancellation rates have jumped to 16%, meaning a growing number of transactions are collapsing late in the process due to financing problems or inspection surprises. The rental market is losing steam too, with vacancy rates inching up to 6%. Tacoma isn't just feeling a chill, it's suffering because Seattle has come down with a full-blown illness. If you're finding this deep, data-driven look into the housing market useful, take a moment to like the video and drop a comment about which city you think we'll explore next. Your support helps us keep digging into the realities behind these shifting local economies. Number 6. Medford, Oregon. You keep heading south, pushing closer and closer to the California state line until you arrive in Medford. Nestled among scenic mountain ranges and long defined by its agricultural heritage, this region is now dealing with a set of economic pressures that are pulling its housing market down faster than what's happening nationally. As you drive through the valley, the effects of a weakening local economy are impossible to miss. One of the biggest blows comes from the collapse of Southern Oregon's legal cannabis industry. What was once a major economic driver has left behind excess land, vacant facilities, and properties that no longer produce income. That financial damage hasn't stayed isolated. It's spilling directly into the residential market. On top of that, Medford has traditionally attracted retirees, but inflation has taken a serious bite out of fixed incomes and pension funds. As a result, a large portion of the buyer base that once supported home values has disappeared almost overnight. Every key indicator in Medford is now flashing warning signs. Local housing reports show months of inventory climbing to nearly 4, a level that firmly hands negotiating power to buyers for the first time in years. At the same time, the median sale price has fallen by 4.5% over the past 12 months, and the pace of that decline is picking up. Sales activity has slowed sharply as well, with monthly transactions down 20%, freezing liquidity and leaving many sellers stuck. Homes are sitting longer too. The average days on market has jumped to around 65 days, meaning sellers may wait 2 full months just to receive a serious offer. New construction has nearly stalled out, with housing starts down 30% as builders struggle to make projects pencil out under high material and financing costs. Affordability has reached a breaking point, with roughly 70% of local households now priced entirely out of the market. Adding to the concern, loan delinquencies and forbearance rates in the county sit about 3% above the state average, hinting at growing financial strain beneath the surface. Price reductions have become commonplace as well, with 38% of sellers cutting their asking prices in an effort to attract interest. As you leave Medford behind, the conclusion is hard to escape. This market is locked in a downward spiral, and there's no clear exit anytime soon. Number 5. Spokane, Washington. You leave the southern valleys in your rearview mirror and begin a long, draining drive to the northeast, climbing over the imposing Cascade Mountains and crossing to the far side of Washington before finally reaching Spokane. Often called the capital of the Inland Empire, Spokane was one of the biggest winners of the pandemic housing surge. It promised urban amenities without coastal price tags, pulling in waves of remote workers eager to escape the rain, congestion, and politics of Western Washington. But as you cruise through the historic neighborhoods of South Hill, it's obvious the momentum has reversed. Hard. Longtime residents who were priced out during the boom are still seething, while many of the newcomers who fueled the run-up are now stuck in homes they can't unload. The energy that once turned Spokane into a modern-day housing gold rush has slammed into an immovable wall. The numbers confirm just how abruptly the market has shifted. Data from Redfin shows the number of homes listed for sale has jumped by more than 35% compared to last year, creating a heavy inventory overhang that buyers are increasingly ignoring because the financial math no longer adds up. The median sale price has effectively stalled out and, when adjusted for inflation, is now down close to 3% in real terms. Homes are no longer selling at lightning speed either. The average property now sits on the market for about 45 days, a jarring change from the single-digit timelines seen just 2 years ago when bidding wars were routine. Nearly 40% of active listings are now posting price cuts, a clear signal that sellers are still clinging to expectations shaped by a market that no longer exists. Builders are responding defensively. Permits for new single-family homes have dropped 20% as developers pull back to avoid flooding an already weakening market. At the same time, inbound migration to Spokane has slowed to a trickle, stripping away the main force that once pushed prices higher. To cap it off, the sale-to-list price ratio has slipped below 100%, officially marking the end of over-asking offers in Spokane. Number 4. Gresham, Oregon. You swing the car back west toward the Portland metro area, but stop just before reaching the city itself, pulling into Gresham. As Oregon's fourth largest city, Gresham has long been viewed as a more affordable suburban refuge for people commuting into Portland. Yet as you move along its main corridors, the mood feels unusually heavy, almost oppressive. The deep-rooted problems facing Portland, rising crime, expanding homelessness, and growing concerns about public safety, have spilled across the border, and Gresham is now paying the price in declining property values. Affordability alone is no longer enough to attract families. Safety has moved to the top of the priority list, and many households are deciding that Gresham no longer provides the sense of security they're looking for. The data paints a stark picture of a community under strain. Local market analysis shows that the median time a home spends on the market has jumped to nearly 50 days, a clear signal that buyers are hesitant at current prices. Sales activity is slowing sharply as well. Closed transactions are down 19% year over year, indicating that liquidity is drying up and leaving homeowners stuck. At the same time, inventory has climbed by 25%, forcing sellers into fierce competition for a shrinking pool of qualified buyers. Signs of distress are becoming harder to ignore, with foreclosure filings in Multnomah County, which includes parts of Gresham, rising by 10%. Prices are already responding to the weakening demand. The average sale price has fallen about 4% as buyer interest fades. Active listings are now sitting at a multi-year high, suggesting that both investors and longtime residents are rushing for the exits. Even the rental market is showing cracks, with vacancy rates climbing past 6% and putting serious pressure on landlords who can no longer rely on quick tenant turnover. Perhaps the most revealing statistic of all is that more than 45% of homes sold in the past quarter closed below their asking price. Gresham is now trapped in a cycle of negative perception, shrinking demand, and eroding pricing power. Number 3. Yakima, Washington. You cross back over the Columbia River and steer into the agricultural core of central Washington, making your way toward Yakima. The city welcomes you with wide stretches of orchards and vineyards, a landscape that looks calm and productive at first glance. But beneath that picturesque surface sits an economy under serious strain, and it's dragging the local housing market down with it. Unlike tech-driven cities such as Seattle, Yakima depends heavily on agriculture and labor-based industries, sectors that are being squeezed hard by inflation, higher fuel prices, and rising operating costs. As you drive through nearby neighborhoods, it becomes clear this market isn't unraveling because of a burst speculative bubble. It's faltering because the people who live here are financially worn out. Affordability in Yakima was never built on high incomes. It relied on low home prices. With mortgage rates climbing sharply, that equation no longer works for the average worker. The data coming out of Yakima is troubling across the board. Zillow reports show the home value index has completely stalled, registering zero year-over-year growth and beginning to trend negative for the first time in years. Mortgage delinquency rates in the county are among the highest in Washington, rising to nearly 4%, a red flag that often precedes an increase in foreclosures. Inventory continues to pile up as well. Active listings are up 30%, with homes sitting unsold month after month. The absorption rate has slowed dramatically, pushing months of supply beyond 4 months and firmly establishing a buyer's market. Sentiment among buyers has collapsed, with mortgage applications for purchases down 25%, signaling a sharp pullback in demand. Pricing pressure is already showing. The average price per square foot has dropped about 2% in just the last quarter. Meanwhile, new listings have increased by 10%, adding even more supply to an already crowded market. Perhaps most telling is that homes selling above asking price have nearly vanished, accounting for less than 10% of all recent transactions. If this clear-eyed look at the housing market is resonating with you, drop a comment below and let us know whether you're seeing similar price drops in your own neighborhood. Number 2. Portland, Oregon. You push west into the worsening weather, crossing steel-span bridges as you enter what was once proudly called the City of Roses. Not long ago, Portland was the Pacific Northwest's favorite success story, a cultural hotspot celebrated for its food scene, creativity, and seemingly unstoppable growth. Now, as you wind through downtown and nearby residential streets, the signs of deterioration are impossible to ignore. Sidewalks are crowded with tents and blue tarps, while for lease signs hang in the windows of empty storefronts that once buzzed with life. What's unfolding here goes far beyond rising mortgage rates. Portland is facing a deep crisis of confidence. Escalating taxes and ongoing public safety concerns have pushed many high-income residents to leave, draining the tax base and crushing demand for both luxury homes and middle-tier housing. The people who once fueled this market are gone, or actively planning their exit. The real estate data reflects the damage. Recent figures from the Regional Multiple Listing Service show that Portland's median sale price has fallen by more than 5% compared to last year, representing a substantial erosion of household wealth. At the same time, active residential listings have ballooned nearly 30%, saturating the market with homes that buyers simply won't touch at current valuations. Homes are sitting far longer too. Average days on market now exceed 50 days, a dramatic slowdown from the rapid turnover of prior years. Downtown commercial vacancy rates have reached record levels, dragging down the value of nearby condos and mixed-use developments. You also learn that Multnomah County has lost over $1 billion in adjusted gross income due to outbound migration, a devastating hit with long-term consequences for property values. Distress is accelerating as well. Foreclosure filings have jumped by 15%, while total home sales are down 23%, signaling a market that has nearly seized up. To make deals happen at all, more than 40% of sellers are now offering major concessions, cutting prices or covering buyer costs just to move their properties. As you continue through the city, one conclusion becomes unavoidable. Portland is deep into a serious correction, and the bottom is still nowhere in sight. Number 1. Seattle, Washington. You point the car north on Interstate 5 for the final stretch of this unsettling journey. As the skyline of the Emerald City comes into view, you're reminded that Seattle has long been the economic powerhouse of the region, home to corporate titans like Amazon and Microsoft, and for years it carried an air of total invincibility. Yet as you pass forests of construction cranes and gleaming glass towers, it becomes clear that this is precisely where the downturn will hit with the most force. The tech industry, which powered a decade of explosive price growth, is now shedding jobs at a brutal pace. Thousands of positions have vanished, and the stock-based compensation packages that once fueled oversized down payments have taken major hits in value. Seattle sits at the center of this collapse because it climbed the highest and now has the longest way down. The data coming out of the region is downright alarming. Redfin figures show that the median sale price in King County has fallen nearly 10% from its peak, wiping out hundreds of thousands of dollars in equity for recent buyers in a shockingly short period of time. Inventory levels have surged as well, jumping more than 40% year over year in certain neighborhoods and creating an oversupply that could take years to fully clear. The pain is especially severe at the top end of the market. Luxury home sales have dropped by more than 30% as wealth contracts and confidence evaporates. Tech layoffs have impacted tens of thousands of local workers, removing a massive portion of well-qualified buyers almost overnight. As a result, the share of homes selling above asking price has collapsed, from over 70% during the frenzy to less than 20% today. Even rentals are losing momentum. Rents are softening, widening the gap between the cost of buying and renting to levels not seen before, which further discourages would-be buyers. Foreclosure activity is beginning to rise as well, with starts up 13% as adjustable-rate mortgages reset and payments spike. Investors have already made their move, or rather, their exit, with investor purchases plunging by a staggering 50%, a clear sign that experienced money wants nothing to do with Seattle right now. You pull over at Cary Park, staring out at the rain-soaked skyline draped in gray. The road trip may be finished, but the financial risk is only beginning. We've just traveled through 10 cities where supply and demand are badly out of balance, and where patience could save buyers tens, if not hundreds, of thousands of dollars. The Pacific Northwest remains breathtakingly beautiful, but at this moment, its real estate market is a dangerous trap. Don't let fear of missing out push you into a costly mistake. If you want to stay ahead of the downturn and protect what you've worked so hard to build, make sure to like this video, subscribe to the channel, and share this warning with anyone considering a move here. Drop a comment below and tell us which region of the country we should road trip through next. Thanks for watching, and drive safe.